listen to it for a little. It's 11, right?
Yeah, it's 11:50. It doesn't start for 10 minutes.
Alexa, set the alarm to go off in 8 minutes, please.
8 minutes. Starting now. Oh, picking up after morning, is that your favorite pastime?
No, I always try shit, we're all over my house. Try not to miss about it.
Oh. Sure.
Because every time I pick them up, even though I'm a little frustrated, I'm like, great, well, let me pick them up.
Yeah. Good way to look at it.
What?
I said, you're absolutely correct. That's a good way to look at it.
Yeah. It's the reality.
And he made us a family. He's a great man. We're both trying to make it perfect, which is tough. And he doesn't need to be perfect.
But if we don't have someone pushing us, or we're not pushing ourselves, then we'll stay stagnant.
At some point, we're gonna be like, hey, I'm 50. Saying, once you reach that almost perfection, you know, not yet. No, I still got work. Guess what? Through all, through God, all is possible. All things are possible. Look how well I've done for
Oh, I might feel right there. That is.
Okay, Justin, I should probably tell him, let's shoot for next video. He's got in-laws. Remember, you want that board for him? Right, thanks, some of those boards. A good cool day for that.
Your friends is
Hi, everybody. Again, if you're reading the chat box, feel free to comment on anything in the chat box. I'll try to keep an eye on it, but you can also speak up if you'd want. And I think I might have to unmute some people, but you can either mute yourself or unmute yourself, I believe. So can everybody see my screen, the share screen? So I'm going to start out today by going through and just kind of running through Market Monitor, the numbers again for the month of April, since everything's hopefully closed out in MLS that was supposed to close. And I'm going to go dive through some more details after that. But just bear with me for a minute. I'm going to go through all the stats for April. So keep in mind when you're using this. So this is in the entire MLS. So I'm just looking at all MLS for Charleston. So here we are, we're up 17% year over year. So 399. So we're almost at 400,000. So 399 is the median price in the Charleston MLS. And last year, if we go back to April, was 341. So think about that for a second, as we've gone from 340 basically to 400,000 in a year. If we go back to April before, we were at 290. So think about that. So 290 to 340 to 400. So, I mean, that's a pretty substantial, let me get my calculator out real quick. So on the 290, so in the past 2 years, so we were 290 and what did I say? 290 to 400. So 10 divided by, so in the past 2 years, we've gone up 38%. So from 2 years ago, the prices are 38% higher. So, I mean, I typically look at median. You can also look at the average here. So the average is up 18% at 585, but keep in mind, if you have a couple of $5, $6, $7, $8 million listings that close, it tends to skew the average number. So the more stable number to look at is median over the long term. So again, 290 to 340 to 400,000. And you know, the median price in the US is right around 400,000. So Charleston itself is sitting about the median of the US right now. So, you know, put it in perspective, is like, we're not the most expensive city, but we're not the cheapest city. So, you know, overall, we're sitting right in the middle. Price per square foot, so up 22%. So the price per square, so sales price was 17%, price per square foot was 22%. So for perspective on price per square foot, why is that higher? Well, this is just my opinion, but I think what's happening is you're having a lot of houses being renovated, right? So houses that were bought, purchased back in here have been renovated. So they've put money, investment capital into the houses, which is bumping that price per square foot. So, you know, that price per square foot is outrunning the sales price a little bit because of improvements that people are putting into the properties, you know, before they sell them. You know, and some of these are flips. You know, some of these are flips that somebody bought for 200,000, put 25,000 into it and selling it for 300,000. So that price per square foot is jumping because of investment money people are putting into their homes. And again, keep in mind, this is all areas. So median price, we're still at 100, right? So half, remember, median means half the houses are selling for, you know, below 100%, half are selling for 100 or higher. If you look at the average, so look at the average. So we're actually over 100% on the average. So we're 101. And you can see that dip from June. You know, we drove it up last year, January to June, right? So we started at 97.6, drove it up to 100.7, came back down to 98.8, going back up, we're at 101. So I expect maybe this trend to continue for a little bit. So by June, we should be probably going back down. And you can see pre-COVID, the typical seasonality, right? We're just at a higher level and readjusting to seasonality, but you can see that seasonality effect. So, I mean, it shows where the peak is kind of spring, summer, and then it falls off into the fall and winter. Days on market. So median days on market, we're still sitting at 3. And again, remember median is half the houses are selling in 3 days or less, half are taking more than 3 days. So, when you look at that perspective, it's like as soon as it comes on, it's going off. Because 3 days is enough time to show the house, gather offers, pick one, get it ratified, change it in MLS. So now also keep in mind, it's middle of May. This 3 reflects when these contracts were written and for April closings. So April closings, those contracts might have been February or before, but those are probably mostly February and March contracts were at 3 days. So that, and again, there's a time lag with what's showing up in the data with what's actually happening. So I want everybody to keep that in mind as we kind of go through this data. The average days on market, we're down to 17. And you can see, little gyrations, but you can just see the seasonality happen, pre-COVID as well. We're just, again, returning to seasonality just at a much lower level. Months of supply. So months of supply, we're at 0.7, which when you look at historically, that's as low as we've been. So 0.7, January, February, March, April. So we're sitting at this low because we have hyper low inventory with obviously a lot of closings happening. Homes for sale. So homes for sale now, again, the way they pull their data, I'm not necessarily in total agreement with their numbers, but they show 1380, which is 31% less than a year ago. So last April we had 2,000 for sale. This April we had 1380. Now realistically, and I have on my calendar here, the middle of March, we hit 928 as a low on, a moment in time when something was listed was 928. So that was the lowest number that I saw. And this morning we were up over 1,400, so about 1,430. And again, I'm not raising any sort of alarm to anybody, but to go from 928 to 1,430, that means we have 50% more to choose from today than we did 60 days ago. Now, 1,400 is still way too low for our market. We need to get back up to 5,000 or 6,000. But for perspective, we have 50% more. So 50%, and I just want to put this in a relative, for your buyers, if that buyer in the middle of March, when we hit the low, had 2 houses that they could look at, now they have 3, right? So they have one more choice. If they had 2, they have 3 now. So it's 50% more to choose from. With higher interest rates, higher prices, I would dare to say less buyer competition. And I'm not saying for a second that we're not having multiple offers and 10% above list and as is and no appraisal. That is still happening, but you can see the change start to happen if there are more houses to choose from for that buyer and less competition for that buyer. Now, again, this will start to change in different areas at different times and to different degrees, but you can see what we have hit the bottom in the middle of March on inventory, and we're slowly going higher. Closed sales. So here's the closed sales. So closed sales, we're off 13% from a year ago. So this April we closed 1906. Last April we closed 2183. So wait for the media to start to report some of these April numbers and say, oh, look, real estate's cooling off, or whatever term they're going to use. Is there a bubble? So they're going to say, oh, look, we closed 13% less than we did a year ago. It's simply because we didn't have anything for sale, right? You can't keep up a pace of 2,000 closings a month when there's 928 for sale. And keep in mind, this April number reflects that low of we only had 928 for sale when we're trying to write contracts and trying to get buyers on paper. So you can't really close, you can't keep up that pace forever with no inventory. New listings, again, reflects a 9% drop in new listings. So last April, we listed almost 2,500 homes. This April, almost 2,300. So it's been harder to get those listings on the market as well. The sellers are becoming unmotivated to some degree because of the fact that they have a low interest rate. They have a low assessment of property taxes. They're comfortable where they live. They can renovate their house. They're not going to give up their rate. So it's been harder for us to find these new listings. And again, this is the one graph when you look at everything. you barely notice COVID because, you know, we've held sellers off the market, but you can see that run up every year, right? December, you know, is the low, and then all of a sudden you get all the listings hitting the market in the spring and summer, and then it falls off again. So we've already started that decline. And usually if you look, let's just go back to 17, right? What's the high month? It's March. Let's go to 18. What's the high month? It's March. 19, March and May, but in that range there. 2020 was a little quirky, right? Because that's when everything shut down for 8 weeks. So we were going up in March, but then things slowed down, and then we ended up peaking in July. But this is all that time lag because of the COVID shutdown, in my opinion. You know, here's March of 2021. Again, we hit a high in July. But traditionally, if you go back in time, and we'll go back a little further, if you go back in time and you look at that high month, it's almost always March. So here's 16 is March, 15 is March, 14 is March. So you follow that trend. So what we're starting to do is we're starting to regain some of that seasonality. The typical seasonality we would see in Charleston. You know, the last couple of years were certainly not normal seasons from a COVID shutdown point and the spikes in COVID and, you know, shutting down schools and all that. So you kind of have to take the last couple of years, you know, you can see the seasonality, but it was a little off. So I think, you know, here we're seeing that March at 2,300, April at 2,279. It'll be interesting to see what May and June bring. Are we peaking at just a lower level? I mean, do we look more like, you know, we did in 16? I mean, here's 2252 and 16, and you can see it started to slide off. You know, are we going to see a slide off? Or are we going to see a bump in May and June because maybe some sellers feel like they're going to cash out of their houses? You know, watch the next couple months, but I think we are returning to what we would typically see on a seasonality basis here in Charleston with, you know, that quick ramp up in listings and then that drop off as you get into late summer into the fall. Let's zoom in again a little bit. So if we look at pending sales, so here's pending sales. So again, 2069 in March, and we're down to 2049 in April. If you look back in time, you know, July was the high here, but again, this is that delay. You can see that drop in April. This was the COVID shutdown period. So you kind of have to some degree, ignore this year. You know, we were at a peak in May in 19, peak in March in 18, kind of a peak in March in 17. So, you know, we're reaching that window of time where we're going to have the most under contract, and you can already see that little fall off from March to April. Again, watch it into, you know, the next couple of years, but we're looking more like 19, 18, 17 from a level standpoint, right? I mean, if this is our peak, we kind of look like a slight growth from these years, not this astronomical growth in these 2 years. Dollar volume. So dollar volume, we're up 3.2%. But I also want to point out is that it's not because of the number of homes we sell. Remember, we closed less sales. It's because the price is so high that we're still able to increase our dollar volume. And you know, you look at the level of 19, 18, 17, you know, we were sitting right in here, and then we just jumped. And the best way to look at this is, let's go and look at a 12-month average. So we kind of get rid of some of the seasonality. So here's, you know, basically coming out of the shutdown. So the typical year, 12-month rolling, we're about 6.5 billion. And we are, and I mean, if a couple of agents maybe enter some big closings in April, think about that. The 12-month rolling average in April is basically $1 billion a month. And we never hit $1 billion, you know, anywhere close to that before COVID. And we're almost averaging $1 billion a month. So it's phenomenal how much that volume has grown because of the price growth and because of the number of closings, right? That combination is reaching at this level. But you can see since last June, you know, we've kind of now we're kind of going up a normal pace of incline. If you look at the incline here, now was abnormal. Now we're returning to some sort of normal dollar volume growth. And if you look at the closed sales, so now we're in a rolling 12 months, right? So let's get rid of seasonality. and we're kind of work our way backwards, right? So there's dollar volume, right? So now maybe this is kind of the pattern that we're going to follow. Here's pending sales. Look at that. So pending sales on a rolling 12-month, we peaked in April of last year. So now this is 12 months of a declining pending sales. And if you look at where we were prior, and just for a ballpark, so prior to COVID, we were about 18,000, so 1,500 sales a month, right? We peaked at 25,000 sales in a year, so over 2,000 sales a month. So we went from 1,500 a month to over 2,000 a month. Where are we going? I mean, this trend, it doesn't look like it's going to all of a sudden change direction again. Are we going to go back to where we were in here at 1,500, 1,600? Maybe so. This might be another year of a decline, and then maybe some sort of stabilization, and then an upward trend like what we saw in here. But we're coming down off the peak. And a lot of this is because we don't have, you can't sell 25,000 a year if you don't have sellers, right? A transaction, you got to have a seller. So, we still have buyers out there, but if you run out of sellers, that transaction count's going down. So pending sales, so we're off 8% on a 12-month rolling average from a year ago. So we've lost 2,000 sales in the past 12 months on a 12-month basis, right? New listings. So, here's COVID shutdown, returning back out of that, jump up, but now we're trailing off again. So we actually listed in the past 12 months less than we did the previous 12 months. So you can see that decline in here. Closed sales, the same trend. Look, since 12-month rolling average, we're declining, and it reflects the pending sales, right? I mean, the pending sales are going to result in closed sales, so it's not surprising that this looks the same way. So we're starting to decline on the closed sales on a 12-month basis. Homes for sale, again, we're still at a hyper low there. Again, don't pay attention to this number necessarily because that's a 12-month rolling average. Months of supply, we're still way quicker than we were a year ago. 0.9 months is the 12-month rolling average, which is historically way lower than we've ever been, right? 3.2 months pre-recession, was a pretty strong market. We're a third of that on an annual basis. Days on market, we've kind of flatlined for several months now that this is as low as we're going to go because you can't really get to a negative, right? So we're as low as we're going here and way lower than we were pre-recession. And keep in mind the normal market, 20 days, right? And this is median, not average, right? So the median in what I would consider, a normal market is around 20. Look at the average. So the average was around 55, 60. So, the average home in 2017 took almost 2 months to sell. Now we're down to, 19 days on average, but the median is even quicker. The median's down to 3 or 4. Percent of original price. So here's the median, right? So pre-recession, we were getting close to 99%, never quite hit it. And then in the recession, we were down. So think about it. We were negotiating 10% on contracts in 2011, 10%. And then we returned back to, let's call it normal, 96.5%. So negotiating 3.5% on average, typical. And now we're back up to basically full price is the average. And the median, so here's your median, we're sitting at 100%. Pre-COVID, we're about 98%. So 98% for median, 96.5% for an average was normal. And again, we were here, back in, for the median, we did this for a couple of years already. Right? If you look at this flat spot here, we were getting 100 or more on over half the contracts. Price per square foot. So again, pretty strong growth on this one, way above where we were at the peak last time. But you can see the steady growth in here. This can't keep going up at this level forever. We're going to have to start to kind of level out at some point. Part of what's happening here is inflation. Part of what's happening here is improvements to houses. And again, as the sellers If they decide not to sell, watch, there's going to be a lot more renovation happening, improving values. So this trend will still continue, I think, at a faster pace than the sales price, because people will be putting more money into their houses, taking HELOCs with the equity that they have, or deciding to stay put and renovating their kitchen or redoing their bathroom. Median price, again, still very strong growth on median price on a 12-month average. So you can see overall the trends are still there, but I just want to caution everybody. It's like, okay, well, the numbers we're looking at reflect March's kind of activity, right? Because that's when all these contracts were written. It's like, okay, well, what's happening now? Well, we have the market now. When you look at it, if we have 1,430 houses for sale, John and I were looking at this earlier, we've almost jumped 200 in the last couple of weeks. So, a 25 net increase per week, that's manageable. I mean, that's 1,200 in a year or so. But you start going up 100 a week, that's 5,000 in a year, right? So that's a very aggressive increase in inventory. So part of what I think we're seeing is this is the typical spring market where we see the houses hitting on the market. But let's go back to the months, right? So if this is monthly, and again, you can see historically the seasonality in every year, right? But let's zoom in a little bit. So, what we're experiencing here is, homes for sale. Where's the new listing? Sorry, the new listing. So again, we seem to be peaking out below where we were previously. But at the same time, we're trying to decipher how many contracts we're writing weekly compared to how many are hitting the market. And it'll be interesting to fast forward the next couple of weeks. But, our inventory has increased 200 in the last 2 weeks. If this trend continues for a little bit, so we are at the highest level today, is the highest level we've been at this year in inventory, right? So if you need to have a conversation with your sellers, if your seller's listed and hasn't sold, this is a great conversation to have with them. The inventory today is the highest it's been this year, right? And this trend doesn't typically all of a sudden go back down. This is where we're at right now. And I expect when we're having a conversation a week from now, it's higher than it is today. And the trend is definitely higher over the past 2 months. And I expect that to continue. So we're still at a very seller's market level, but things are changing. And if we go back, for number reference, if we go back to the closed sales, right, and we have been managing to close over 2,000 some months, but let's say we go back to the norm of 1,500, especially when you look at it on, rolling, if we go back to this norm of 18,000 a year, which is 1,500 a month. So let's do, and again, it's not going to happen tomorrow, right? We're still very high on count, but the pending sales reflect, right? Here's your pending sales. What are we reflecting? Down 8%. What's that mean for June closings, right? I expect June closings to be down, right? If pending sales are down, closings will be down. So when you do that number, and let's say we do go back to selling 1,500 a month, right? 4 months of inventory is how many? It's 6,000 for sale, right? So if we go back to 1,500 in a couple of years, and we have 6,000 for sale, that feels like a 2017, 18, 19 market, which, again, in my 20 years, that's about as normal of a market as I felt. 9/11 was a weird time. Pre-recession was weird. Recession was weird. The growth back up after the recession took a while. This was as normal of a market as I probably have felt in my career. So if we trend to go back to this level, we still have to get from 1,400 a day up to 6,000, and we have to go down from under 2,000 per closings a month to 1,500. So this isn't happening tomorrow, but this trend is definitely showing you we're headed that direction. And obviously the higher interest rates, are going to make that happen quicker. You might watch this become steeper because of the higher rates. We could be dropping off buyers quicker because of those higher rates. At the same time, we might lose some sellers, who, if rates are 5% plus, and they're at 2.75, they're just not going to move. So we've got dynamics here kind of fighting each other of, I think we're losing demand and we're losing supply at the same time. Which one happens quicker? Right? I mean, your conversations with the sellers, I mean, yeah, some people are trying to cash out and you can see it right now, but where are they going? You know, you got to have a place to live unless they have a job reload or something that's, they already have a place to go. You know, it's hard to justify moving if you don't have a good alternative, especially if you're getting a loan. If you're getting a loan, you're obviously paying higher rates than your current house if you're already an existing homeowner. One other thing I wanted to share that I never thought of it this way, but let me go back to sales price. So when you look at sales price, and we're going to go back, let's go back 10 years. So I started thinking about everything and I'm like, I've always kind of noticed that seasonality trend. Obviously, we have more buyers in the spring, more listings in the spring. It seems obviously as agents, we're always busier in the spring and summer. So watch this. If I go from a rolling 12 months, so remember, rolling 12 months is taking 12 months of data and averaging it. So this is the best way to get rid of seasonality. Because if we don't get rid of seasonality, let's look at median, then you get a lot of gyrations. So rolling 12 months gets rid of any seasonality. So it shows what I think is a market trend, right? A market trend is higher or lower rather than the seasonality. But watch this. If I go do 6 months, right? So I'm just going to do 6 months. So now this is just looking at 6 months at a time. And let's go prior to when this was happening. What I've always noticed is, so here in January of 2012, we're at 185,000. If we go to the summer, we went from 185 to 196. So we had a nice little growth. Again, it's all relative, right? We were going up in value here. But then watch what happens the second half of the year. And I'm trying to get my cursor out of the way. See how flat the second half of the year looks? Right? So in August, we were at 195. In January, we're actually below that. Right? And then watch what happens the next year. Once you go to spring, then you're at 202. And you flatten out, right? So in December, we're at 208, but it's hard to tell. But if you look at this, you're uptick in the spring and then kind of flat or even down in the second half. Here's your uptick in the spring, flat. So this is what the 6 months is showing you, is that your first half of the year is where you get a lot of your appreciation. And even look at the last year prior to COVID, we're at 268 in January. We went up in the 280 range in the summer and then back basically flat the rest of the year. So you have 6 months of price growth and then 6 months of kind of almost sideways movement and then 6 months of price growth. And it's strictly because when you look at, you know, and let's go back to monthly, when you zoom in and you look at the trends, you know, you have, when you get to, let me see here, let me do the inventory, homes for sale. Let's see here, closed sales. So when you have your closed sales, look where the peak is, right? So this is all the contracts coming in and driving that traffic and prices higher. And then when you lose that demand, but still have reasonable supply, you're losing that ability to keep raising the prices. So this second half of decline in closed sales keeps the prices relatively flat. So here we are, what is today? May 13th, right? We're almost through the first 6 months. In fact, most of June closings, or a lot of the June closings, have already been written as contracts. So this hyper growth that we've seen, let's go to sales price. Let's zoom in, right? So if we go just this, look, in January, we're at 361. So watch this hyper growth, 361, 375, 385, up to 399, right? So we've gone just in what, 4 months from 361 to 499 to almost 400,000. So if I do the math on that, you know, we've increased our value 11% in 4 months, right? So if we keep going higher into, maybe we go higher into May and June, we might get our 15% growth, in the first 6 months, and then the next 6 months. So look what happened here. Look at the second half. Look, once you reach June, so here's 2021, 315 to 355, right? Now we're zooming in on a year. Now watch what happened the second half. Almost nothing, right? Now we ended up at 365 in November. I can't explain why this. Maybe there were a few sales that were high, and also you didn't have as many sales, but you always have that first 6 months of growth in price. You can see it clearly defined in here and here. And let's, next month we can look at this, look what happens in May and June, but this is probably almost a straight line up, and then you get some sideways movement. So, from your seller perspective, they're still in that window of time on the tail end of it, that they're being driven by the high demand of the spring buying season, with still increasing supply now though. So your window as a seller is for the year is probably starting to close a little bit of having that high demand. Because who in November and December did it feel like it did today? Not quite. Yeah, we had low inventory and high demand, but we didn't get 30 showings and 10 offers in a day, right? So this second half of the year behaves differently, and you need to have a conversation with your sellers from a standpoint of, if they're not at the right price, then get there quick. If you're talking to your buyers and they're losing out on houses, it's like, keep trying and have some patience, because what's going to happen the second half of the year, if we have this increasing inventory trend with higher rates and again, closed sales are lower, you're dealing with less competition, with more to pick from. Even if it's a slight variation, it's changing over time, that it's not quite the same level of the amount of demand compared to supply is changing. And they're both changing at the same time. And I'm not going to say it's level, it's still a hyper seller's market, but it is starting to change. Anybody have, before we go into other details, anybody have any comments? John, you want to say anything, or?
Do you think that with the volatility that we're seeing in the stock market, and for those who do the digital currencies, pull money out, you think, and for the short term, maybe see an influx of more buyers? Because I feel the same way you do. With the interest rates, that's hitting people pretty heavy who are financing. But are people going to remove it from that institution and safe place bet it into real estate for the short term? Because there's so much volatility if you're watching those markets. I'm just curious. We'll see a little spike in activity of buyers that might help erode some of this, what we're witnessing in terms of inventory. But I still think I think inventory is going to continue creeping up for some time.
Yeah, and again, the volatility in the stock market has been, yes, it's been like this in the past, but the past, since the beginning of the year, the volatility has been huge. Inflation, the war, the cryptocurrencies, there's been so much volatility that, house prices don't do that, right?
Right.
You can't check your house price every day and if Bitcoin's up 8% today and down 10% tomorrow, that's not what a house does. So, a house is a more kind of stable long-term investment. And I think that's where you're seeing a lot of these capital ventures that are putting money and buying houses sight unseen, because they look at the overall return, and if they have a long-term outlook, then they realize that it can actually beat the stock market. And I think you talk to a lot of people, and again, I'm not a stock market expert. So first of all, I want to say that, but the volatility and the growth that we've had in the stock market, I think you're looking at the viewpoint of the next 10 years might not be a positive for stocks overall. And if people realize that they can get rental income and tax depreciation and principal pay down and cash flow, then they're realizing when you look at the whole package, so houses since 1980 in the US have gone up 4.6% a year. So if you just straight line for 42 years, it's 4.6% per year. And people are like, oh, well, stocks go up 8 to 10%. I'm like, well, the 4.62% is strictly appreciation. You're not looking at the rental cash flow. You're not looking at the principal pay down, the tax deductions. So when you put that total package together, it's higher than the stock return. right? And I think these capital venture funds have that long-term outlook. They're not trying to be Zillow and doing the Zillow offers and flipping houses. They're like, we're going to buy this and we're going to rent it and we're just going to hold it, right? And think about the fixed rate, and this is the best way to combat inflation, right? If inflation's 8.5, and even if you have a 30-year fix at 5%, you're still beating inflation, right? That's the one way to assure yourself of a house payment. Whether you're a primary residence person or an investor, primary residence, it's your most expensive, it should be your most expensive monthly payment. And based off of that, you can fix your most expensive payment. And that's the advantage of owning versus renting. So let's flip over to the investors. Even if they're having to purchase at 5.5%, well, the advantage that they have is that if inflation's 8.5, guess what rents are doing? They're going to be going up. And so you're fixing, as an investor, you're fixing your payment outside of other influences, like if homeowners insurance changes and other things, but you have a relatively fixed payment as rental rates go up. So even if this year is maybe a neutral cash flow, over time it's going to improve. And when you look at your overall return, it's still a good investment. I mean, I sold a townhome probably right at the low of the interest rates, and I had a girl that bought that place, and she's 24 years old, and she bought a 2.5% 30-year fix as a primary residence. And I told her, I said, you're never going to sell this house. You should never sell this property, because you're never going to see 2.5% again. So when you're done with it and you want a different house or different location, just keep it as an investment, because that 2.5% is going to crush it. And look at what's happening. And this is way before this inflation. Now look at it as like, well, if she decides to rent it out and she can raise rents by 8.5% a year, then she's so far ahead of her payment on a fixed, with the 2.5% fixed rate. So I think a lot of these investors and capital funds are getting a little kind of skeptical on the stock market over the long term. I mean, and I mean long term is, if you look at the next 10 or 20 years, most people I talk to or articles I read, it's like, we might not have the same growth that we've had over the last 20 years of the stock market. It might be behaving differently. And it's something that you can, put your hands on and touch and feel and understand better, and have, the ability to control some things. You can't go online and sell it and get your money tomorrow, but it's, as a long-term asset, it's something that you can't replace. So John, to your point, I think we could see more of those kind of come on the market and kind of keep the inventory from going up too quickly. And like we saw last year, so I'm looking at my calendar in the office, last year we hit the low on May 18th. So next week was our low. So we had 1,289 a year ago, but then we went up to 2,100 in September. So don't freak out at 1,400. We were at 2,100 in September, and then we went right back down, right? And we went right back down all the way through the new year to March. But going down in January, February, March on inventory is not the normal seasonality. So don't get used to that as the normal seasonality. That was still kind of readjustment from, if we look at homes for sale, and let's go back in time a little bit, going down in inventory that time of year is not normal. So, I mean, and even getting past the recession period, if you look at when the low in inventory is, it's usually December, right? The end of December, people aren't listing, things come off the market. And then, and again, I know this scale is, so we hit 5,918 in December of 15, and then we went up to 6,300, right? So net effect was only 400 or so. Right. So this is kind of the normal, here's the recession, right? Boom. But then you look at the normal variances in the year, it's not dramatic. And so, we're kind of still unwinding. And I want everybody to realize we were starting this decline in inventory prior to COVID, right? So look at the end of 19, and here I'll zoom in a little bit so we can see this. So, the middle of 19, let's look at the end of 18 was 5808. The end of 19 was 5531. right? So we were already, that's before anybody knew about this cruise ship off the coast and all this other stuff. So this was well before. So we had already started this decline, and then we just accelerated it with everything else that's happening. Part of it is lack of building for 10 years, but this kind of drove where we're at. And you know, we will return to a normal seasonality. So I expect us to continue to go up, right? And when we kind of level out this year, I mean, we did it September, I'm looking at the calendar again, September 5th last year was the high. So the low was May 18th, the high was September 5th. So we hit our low in March, but I think that was more of kind of the market low, not the seasonal low. And so we're going up. Do we go up until school starts again? Right? I mean, we could, and that's pretty typical. I mean, when you look at new listings, you know, we kind of hit a peak, but then we really drop off when school starts. You know, we always have that big drop in September. So look at August to September every year, boom, big drop. You know, August to September. So you drop off because of what's happening. Kids are back in school. Anybody who has kids doesn't want to sell that month, right? And then we decline. We always have a bump in October. I wish I had logic behind that. I think that's kind of the end of the year move, people saying, hey, October I'll list because I want to move at the end of the year, right? But then it drops way off in November and December. So other than this October bump, it is a decline the rest of the year. So I expect our new listings to continue to go up at least through May, June, July, August. And then September, I think we're returning to some sort of normal seasonality. So we're going to go up the next few months, but then September is going to be a drop, October will be an increase, and then down for the rest of the year. But opposite of what happened this year, where inventory kept decreasing, look at these increases in new listings when you hit from December to January to February to March. Look at that rise. So we listed 1,244 homes in December, but by March, just 3 months later, we're doing 2,561. So we more than doubled listings hitting the market in a 3-month window, but that's normal for the start of the year. So I expect us to start to follow this normal seasonality. Now, again, it's all going to depend on how much demand is backing it up, right? We're going to list less homes the second half of the year. The question is the demand still going to override the houses hitting the market? And are we going to decrease our net inventory when school starts? I mean, so I expect what we've seen the last 2 months of an increase in listing in net active listings. We're that way until September. And then let's check it out in September and see where we're at. But I mean, again, 100 a week the last 2 weeks is a pretty significant increase. And what's amazing to me is we've been writing a lot of contracts. You know, 2 weeks ago, I think we were near our high. And then last week, we almost hit 500 in a week. So it's not from a lack of contracts, but it just shows how many houses are hitting the market. And again, you're going to, maybe we're a little time lagged and delay on hitting the market, but you can see once you get past May, because again, when the kids are out of school, it tends to slow down on new listings too, right? So here's, once you hit May, look at the drop off in June, right? And if you go, here's March, April, May, drop off June, July, you know, because what's happening, June, July, August, people are on vacation, getting ready for school. And by July, they're like, you know, we're not going to be able to move before school starts, and they don't bother with it. So, I mean, a lot of this is, and not everybody has kids, but this has influenced a big percentage of the people that are moving do have kids. So it does have a huge influence on, the school year has a huge influence on why the seasonality looks like this. So, you know, again, the next few months is going to be critical on how fast do the net active listings go up. And it's driven by how many are hitting the market and how much demand is still there. So it's supply and demand combined, but you can see more price reductions. You can see more withdrawals. People shot for the moon and they didn't get it. And they're like, well, it's not worth me selling for this price where I was willing to sell for this price. So you're seeing a lot more change of status that has nothing to do with going under contract, right? It's cancellations, it's price reductions, and again, not an alarming amount, but you can tell that people are overshooting. And I think this is an important conversation with your sellers, is that let the demand drive that market, get it close. And again, at some point, comps are going to matter, right? And they will matter. And I know we've kind of gone to this market where it's like all that matters is what's active. But at some point, the buyers are pushing back, and you can feel it right now. The buyers are pushing back because the prices are so high. They don't want to overpay. Interest rates are higher. The stock market's a mess. You know, cryptocurrencies, there's a war, there's inflation. There's a lot of stuff rattling around in the buyer's head that's making them nervous on paying too much and committing to too high of a payment. So you have to have conversations with your sellers that, you know, they might have heard the one story of the house that had 20 offers and got 10% over list, but maybe that was 3 months ago. So you just have to prepare them for, yes, we might get multiple offers, but we still need a price relative to, you know, I'd say somewhere between the comps and what's active, right? We're kind of transitioning back to comps at some point. If you have 5 offers, yes, the comps don't matter. If you only have 1 offer, the comps will matter. So, you know, you got to tell which house you're listing, which property you're listing, how much demand there will be, and price it according to, you know, the expectations and the demand. And if a seller price is a little low, the market's going to take it higher. So, you know, you don't have to, you more have to worry about if you price it too high and you leave yourself out there too long, the market's saying, well, that's, you know, they're priced too high. You know, once a few days, and buyers are smart, you know, once a few days go by, if it's not under contract and there's no multiple offers, they realize, you know, it's too high. I'm going to negotiate off of this. So, you know, at some point, this market will return to what is a kind of normal market where a buyer can look at a house, they can come look at it next weekend, they can make an offer, they can negotiate, they can ask for repairs, you know, the appraisal will matter, CL 100 will matter. You know, all of this is going to come back into play, and we just have to watch when that starts to happen. And it won't happen all at once, but you're going to see a house that you think should sell, and it's going to be sitting there, and you're going to scratch your head and like, well, I know that neighborhood pretty well. That looks like a pretty nice house. Why is it not selling? And it's probably because they overshot the market. So, well, that's most of what I wanted to talk about for today. Anybody want to add anything?
Well, I have a question kind of going back to that. So part of what I'm doing is reaching out, and I know the island and Wild Dunes is probably a little bit, you know, it's different, but so you have people that have owned for many, many years and it's their second home, right? So they can take advantage of the seller's market and make that money. However, you know, it's also bad for them to reinvest it in the market. So how can I approach them so that it makes sense to them to sell it?
Yeah, and it's going to be a matter of, and this is the whole thing, whether you're an investor or whether you're a primary residence, is like, either if you're primary, where you're going to move to and put your money. If you're an investor, what's going to happen to that money? Because obviously, if they're nervous about what's happened with the stock market, real estate is still more of a known investment to them.
Yeah.
And again, they might be able to take that high priced, you know, on the islands and convert it into 4 homes that are less priced. I mean, if you got somebody who's selling a $4 million home on the island, maybe they buy $4 million homes, you know, kind of diversify a little bit.
Yeah.
So it's about diversification and, you know, maybe a lower price point, because historically the lower, you know, this is the first market I've been in where the higher price point, it doesn't even matter like what price point you're at. It's everything's behaving like a hyper seller's market. But I can tell you, I've been in the business many years that I wasn't really excited about a $2 million listing because I'm like, this thing's never going to sell.
Right.
You know, I'd take the 500,000 over the 2 million all day long because I knew I could sell it. So at some point, I expect those, you know, those really high end sales are going to slow down more than the I need a place to live sales, which are the lower price points, right? So I think it's a matter of take off some of that high end, that's more, because think about it, $4 million sale, whoever's buying that or selling that is probably has a lot in stock investments, right? It's not their only investment. So, diversify a little bit, get to a lower price point that you're more guaranteed of a certain income, rental, and diversify their real estate. It's okay to have real estate investments, but diversify it.
Right. Okay. Because, I still have more buyers wanting to be on the island than there are homes.
Yep. Yep. And I'd say, with 1,400 for sale and we're closing still almost 2,000 a month, that's showing we still have way more demand than supply. But I guess my point of this conversation, it is changing, right? We're still a hyper sellers market, but we are, I think when you look back in time, March of 2022 will be that moment in time you're like, this was insane. And I think that was the peak month because you had the lowest supply with the highest demand over it. And I think both those numbers are starting to change.
Okay. Thank you.
Sure. Well, I hope everybody has a wonderful weekend, and we'll do this again next month. And again, this is a critical 6 months of watching these trends because they are changing. And the question is, how fast are they changing? And that's why I kind of write down this inventory every day, because I want to see how fast this is happening. Because again, I lived through that recession and as a real estate agent, and I can tell you it did not feel good from a standpoint of, and I'm not saying we have a recession or anything coming, but the dramatic change from basically 05 to in here, I want to see how fast our inventory is going to come back up, because we're at a low. I want to see what that trend line looks like, and so I can be prepared to see, how fast we're going up and how high we're going to end up. So, I mean, I expect us hopefully to end up back in here where we were. The question is, how fast do we get there? All right. Have a great weekend, everybody. Go sell a house or two and enjoy some time off too. So,
Thanks,
Thank
guys.
you.
bye.
Bye.
Bye.